now. So this is chapter 14 in the income tax course at Newberry College, fall of 2023. And let's start the chapter with a discussion of the first learning objective, and it's about dwelling units. Is the dwelling unit a principal residence, a residence, including residences used for rental purposes, or a non-residence? And the first question that you get to is it a dwelling unit? Okay, so what is a dwelling unit? A dwelling unit can be a house, it could be a condominium, it could be a mobile home, it could be a boat or other similar property. Presumably a recreational vehicle could be a dwelling unit. A sedan probably wouldn't be a dwelling unit, but I could imagine circumstances in which, supposedly the comedian Jim Carrey lived in his car for a couple of years growing up. Maybe that could have been a dwelling unit in appropriate cases. Although there probably wouldn't be a lot of tax issues associated with that sedan as a dwelling unit. So there are tax consequences for, whether or not a dwelling unit is a principal residence. There's a lot of tax breaks for principal residences, and we're going to look at some of those tax breaks, both for deductions that you get on your income taxes, and also for gain that you can exclude when you sell a principal residence. Whether a dwelling unit is a residence or a non-residence is based on kind of a bright line test. And that's where it's used for at least 14 days or 10% of the rental days during the year. If it qualifies as your residence. Now, what it means, there's also a tax detriment to having property qualify as your residence. If it qualifies as your residence, you can't deduct a loss on your rental activities. So that's another consequence of having it be. That's a tax detriment that you get from having it be your residence. And you can see the different tests for, what's considered to be a rental use day, what's considered to be a personal or residence day, and days that you work on the property, if it's both used for rental and principal residence, how those are counted. And so what you can see in Exhibit 14-1 are the tax provisions by the type of property. And what you can see is that principal residences qualify for basically all the tax provisions. Principal residences are in there for all 6 of those. And then for a residence that's not principal, you've got 4 that you definitely qualify, and 1 that you might qualify if you meet the definition of what's a principal residence. And a principal residence is a residence that you've used for your main residence for 2 years out of the 5 years prior to a sale, and that's to qualify for that exclusion of gain. And then a non-residence doesn't give you a deduction for home mortgage interest or home mortgage insurance, but it does give you a deduction for real property taxes, subject to some limits that we'll talk about, and deductions associated with rental use, and exclusion on the gain of sale if it qualifies as a principal residence under that test for exclusion of gain. So you can have some residences that basically have two qualifications. You can qualify as a non-residence while you're using them for rental, but they still qualify as a principal residence because during the 5 years past, you had at least 2 years where you used it as your principal residence. Okay, so what are the key facts, the tax and non-tax consequences of home ownership. And you may see a question about this in your quiz for tomorrow night. So there is a quiz that's due tomorrow night. It's very simple. It's just multiple choice, and it just basically covers the basic facts of this chapter. And you can find most of the basic facts by looking for the boldface definitions and for looking for these little boxes that say the key facts and figuring out the answer from that. So the tax and non-tax consequences of home ownership. The non-tax consequences are it's most people's largest financial investment, and you have the potential for a big return, and most people do get a big return on their investment with the use of leverage for debt, and you usually get your lowest borrowing interest rate when it is your principal home, your principal residence. But you also have potential for loss too, and there have been some times, even during recent years, 2008 in particular, where because of very lax lending standards, when those standards tightened up and when the economy turned bad, there were some very large losses. There's a risk of default on a home loan. There's the time and cost of maintenance. As having been the the kind of husband in the family for all these years in my home, I can tell you that maintenance is something that I prefer to hire out. I can change a light bulb and a battery, but that's about it. And there's limited mobility. When you own a home, you're kind of stuck there. If you rent, a lot of times you can pack up and leave. So there's that. And then for your tax consequences, what we're interested about for this course is that, you get deductible interest expense that you can use as an itemized deduction if you don't use the standard deduction. You have excludable gain on sale if you qualify under the ownership and use test. And you have deductible real property taxes on your home, but that's, again, subject to a very strict limit. And there's potential for rental and business use. And I've certainly had all of that on most of my homes during the last 30 or 40 years, where we've used part of the house for business or for rental and part for living in. Okay, the key facts with respect to the exclusion of gain on the sale of the principal residence. You have to meet both the ownership and the use tests. Ownership means you have to have owned the home for at least 2 of the 5 years before the sale, at least one of the taxpayers if they're joint. And you must use the home as your principal residence for at least 2 of the 5 years before the sale. And for married couples to qualify for the maximum exclusion on a joint return, one spouse only has to meet the ownership test, as I just said, but both spouses have to meet the use test. And the use test, 2 years out of 5, what does 2 years out of 5 mean? Well, it literally means 730 days of use as your principal residence during the 5 years ending on the date of sale. So you can go back and look at your calendars and see where you were and when you went on vacation, and if you have other homes where you stayed at your other homes, or if you stayed at other relatives' houses. And you have to go back and look and be in a position to prove to the IRS, if they challenge it, that you've got 730 days of use as your principal residence during that 5-year period. So that's a test that sometimes you can prove with phone records or utility records, or just with your calendar, if you keep a calendar of where you are every day. But a lot of times people don't, and then you have to go back and scramble and figure it out from those secondary sources. Okay, let's take a look at an example 14. I guess we should start with 14.1 and then do 14.2 and 14.3 because they're sequential. So let's look at the example in 14-1. So we've got the Jeffersons who sold their Denver home before moving to Chicago. They sold it for $450,000, and they had purchased it for $350,000. And they owned and lived in the home as their principal residence for 4 years before selling. How much of the $100,000 gain realized on the sale do they recognize? And the answer is zero. They qualify for the full exclusion available to married couples filing jointly because they met the ownership test and they met the use test. And so they can exclude the entire $100,000 of gain, and they could have excluded up to $500,000 of gain on the sale. And if they had sold the house for more than $850,000, if they'd sold it for $850,000 and $1, they would have paid capital gains tax on that $1. They would have paid, whatever, 15 cents a tax on that $1, maybe, or maybe they could have rounded it down to zero. So that's how that works. Now, suppose that after Tyler and Jasmine were married, Jasmine moved into Tyler's home located in Denver. Tyler had purchased the house 2 years before the marriage. After the marriage, the couple lived in the home together as their principal residence for 4 years before selling the home and moving to Chicago. Tyler was the sole owner of the house for the entire 6 years he resided in the house. Would the gain on the sale of the home qualify for the $500,000 exclusion that's available to married couples filing jointly, even though Jasmine was never an owner? And the answer is yes. Only one spouse has to meet the ownership test, and both of them meet the use test, so they qualify for the same exclusion. Now, what if Tyler and Jasmine had only lived in the home together for 1 year before selling the house? Well, at this point, they have a spouse that meets the ownership test for 2 years because Tyler's owned it for 3 years. But Tyler's met the use test for 3 years. Jasmine's only met it for 1 year. So they only get to take the $250,000 exclusion because they don't have both spouses meeting the qualifying use test. Everybody clear on that? That's an important point. So let's put it all together. What if the Jeffersons purchased home number 1 on January 1st, 2019 for $350,000, and they lived in that as their principal residence until January 1st, 2022, when they moved into a new principal residence, home number 2. And they finally sold home number 1 on January 1st, 2024. As you can see, that's 2 years later, for $450,000. What amount of the $100,000 gain do they recognize on the sale of the house? They have a realized gain of $100,000, $450 minus $350. But what is their recognized gain? And the answer is zero, because again, they meet the ownership and the use test. You have to look at, what they did. So they bought the house together in this example on January 1st, 2019, and they used it for 3 full years as their principal residence until January 1st, 2022. And then they finally sold the house 2 years later, but they've still got the 2 years of qualifying ownership. They've got several years, they've got 5 years of qualifying ownership, and they've got 3 years each of qualifying use prior to the sale in that 5-year period. And so they qualify for the full $500,000 exclusion. Of course, they only have to use $100,000 of it. Assume the same facts, except on January 1st, 2023, the Jeffersons moved back into home number 1 and used it as their principal residence until they sold it for $450,000 on January 1st, 2024. Now, this is an example of how stupid this test is. What amount of the $100,000 gain on the sale of home number 1 do the Jeffersons recognize? The Jeffersons meet the ownership test for home number 1. They qualify for the maximum potential $500,000 exclusion. However, because they stopped using the home as their principal residence for a period on or after January 1st, 2029, and they have non-qualified use for 1 year, basically, for year 2022, and then they used it again as their principal residence before selling, the gain eligible for exclusion has to be excluded. And since you've got 1 year of non-qualifying use during that period, you have to you have to reduce the exclusion by 20%. And so that's 1 year out of 5. So they only get to exclude 80,000 and not the full 100,000. That's a really stupid rule, but it's in the tax code. I mean, why the first part of that answer and the second part of that answer aren't the same? Why they don't get the full 100,000 exclusion makes no sense to me. And they need to fix that with the technical corrections bill in Congress. That's how the Ways and Means Committee and the Senate Finance Committee fixes these obvious stupid provisions in the tax code. There's no reason why, if they got their qualifying use up to 4 years out of 5 years, why an interruption in the middle of that would reduce their tax benefit by 20%. That's just a trap for the unwary. What that means is that you can kind of never move out and move back into your house prior to selling it. That makes no sense at all. Okay. Exhibit 14-2, formula for determining the maximum home sale exclusion in unforeseen circumstances is the full exclusion times the number of qualifying months divided by 24 months. And this is in a situation because the taxpayer has to sell the house because of a change of employment, health, or other unforeseen circumstances. So if you own the house, you use it as your principal residence, but you don't meet the 2-year test strictly because you've been reassigned to work someplace else, or your health has diminished and you have to sell the house, you're going to move into assisted living or something like that, then you get the exclusion, but it's multiplied by the percentage of qualifying months that you have out of the 24 months that you're required to have. So that's also something that you may see again at some time in the near future, maybe the previous question, but you almost certainly will have a question about Chapter 14 in addition to the multiple choice questions, because this is such an important chapter because it involves everybody's biggest investment. I mean, your home is for the vast majority of Americans, it's their biggest investment. If you operate in the tax business, everybody's going to have tax questions that are related to their home. The next section, okay, so we've done the first one, what's a dwelling unit? We've done the second one regarding the exclusion of gain and the different permutations of that. Now we get to page 8 and 9 and the discussion of the home mortgage interest deduction. And the home mortgage interest deduction is one that used to be unlimited, but because of the increasingly large values and the incredible prices of homes, and to try to discourage people going into millions of dollars of debt to buy a home, they have limited the home mortgage interest deduction to acquisition indebtedness of $750,000 for indebtedness incurred after December 15th, 2017, and the limit prior to that was $1 million prior to December 16th, 2017. So they've been scaling this back in tax bills as a way largely to pay for the tax reductions, the tax cut reductions. They've been cutting back on the amount of deductible itemized deductions. They've also been encouraging people to take the standard deduction as opposed to itemizing as a way to try to simplify the tax code, because for many people, itemizing their deductions is more complicated than just simply taking the standard deduction. The key facts of all this are presented on page 14-10 for the home mortgage interest deduction, and let's just kind of go through those. So the deduction is allowed for home mortgage interest on acquisition indebtedness, and that could be either a principal residence or it could be and it could be one other residence. So you can have two residences that you're deducting mortgage interest on. The acquisition indebtedness, the proceeds, the definitions of proceeds are used to acquire or substantially improve a qualified residence. What does substantially improve mean? What does substantially improve mean? What's substantial improvement for this refinancing purposes?
Taking a loan out to fix the house?
Yeah. I mean, taking a loan out to, to pay for construction of improvements. It could be either, big repairs like roof repairs, paving, maybe an addition, maybe, if the house is contaminated by water, getting the black mold out and that kind of stuff to make the house habitable again. Kind of the stuff that ServPro can't fix, but that you can get a contractor to come in and cut out the drywall and replace it and that sort of thing. So there's a financial standard for substantial improvement, and I don't see it quickly in the chapter. I thought I read it when I went through originally, but I don't want to tell you the wrong thing and guess. So maybe read this again more carefully than I can right now during class, and see if you can find the definition of substantial improvement, or perhaps you can look it up in the tax code in section 163. That's an important thing. Okay, the way that you find out how much your home mortgage interest deduction is that every lender is supposed to send you this Form 1098. And this form, which is at the bottom of page 12 in the chapter, lists the amount, lists your name, of course, and who the lender is, and it shows how much mortgage interest was paid during the tax year. And again, it's Form 1098, not 1099. 1099 is for income. 1098 is the mortgage interest statement. And you have a discussion in here of the payment of points with the in connection with the acquisition of a loan, and how the treatment of points is handled. And sometimes they're immediately deductible, sometimes they're not. But in any event, you can take a look at that on your own. Let's go on to real property taxes. Real property taxes are deductible. You have an itemized deduction on your Form 1040 for taxes, but all taxes, all deductible taxes, all state and local taxes are limited in total to $10,000 per taxpayer per year. And so if you already have $10,000 in state income taxes that you're paying, you really don't get any benefit from your real property taxes. Or if you have real property taxes of $10,000 or greater, you don't get any benefit from your state income taxes that you pay. And that's summarized at the bottom in the key facts provision at the bottom of 10-15. And you can see that in your chapter. And those taxes also are typically reported to you, although you get, if they're paid through an escrow or lender's account. But this applies to homes, land, business buildings, other types of real estate. I told you about the deduction limit. You may see a question about that sometime soon. And then homeowners frequently pay real property tax through an escrow account. There's typically an escrow account that provides for insurance and taxes to be paid through the mortgage payment by the lender or the lender servicing agent. And then when homeowners sell the home during the year, the deduction that they get is based on the proportion of the year the taxpayer lived in the home, no matter who actually pays the tax. If it's paid out of a closing statement and prorated between between the borrower between the buyer and the seller. The buyer is typically the borrower on a closing statement, or CD, as they say now, the cumulative disclosure. Okay, let's look at rental use of the home. So this is the fifth learning objective in the chapter. So the tax treatment of rental use depends on the amount of personal and rental use, and there's three categories. And those three categories are residences with minimal rental use, personal residence, residences with significant rental use like a vacation property, and non-residences, just rental property. And the ones with minimal rental use are the ones that the taxpayer lives in the home for at least 15 days and rents it for 14 days or fewer. They call this rule, does anybody live in Augusta or live close to Augusta, Georgia? They call this rule the master's rule. Okay, this is the master's rule. If you own a house in Augusta and it's the kind of house that some group of golfing enthusiasts or corporate junket would like to come down and they have tickets to see the Masters, you can rent your house for up to 14 days. They do it for the Olympics too, although the Olympics typically last a little bit longer than 14 days. So you got to be careful with that. But when the Olympics were in Atlanta, people did this as well. So if you rent it for 14 days or fewer, you can get an amazing check for some of these house rentals. I mean, it's just unbelievable what people will come and pay you to stay in a house if it's close to Augusta National for the Masters. I mean, you might get $10,000, $20,000, $50,000, maybe $100,000, depending, on how many bedrooms and how wealthy and how desperate the corporate junket is. And you don't have to pay any tax on that at all. That income, you can put it in your pocket and spend it. You don't pay any tax whatsoever on the full 10,000, 20, 50, 100,000 that you get for that 1 week rental of your house, 14 days or less. But you can't take any expenses. So if you have to fix it up to get it all nice for the people who were coming, if you have unusual, if they use a lot of electricity and you have a lot of utility expense while they're there, or if you have to get a special insurance policy or something like that you have to pay for in order to make sure that your house is insured if any of those fat cats, fall down the stairs or slip on the sidewalk or something, then you don't get to take that rental deduction. But you can take the full amount of the income, put it in your bank, put it in your pocket, and pay no tax on it whatsoever. It's completely legal. So that's the minimal rental use rule. Really great thing. And then I've had people who've rented their houses out for. I've got some clients who have some old farmhouses, out in the country stuff, and they've rented them to film crews for filming. And we've had to go back into the contract and say to them, look, if you keep your shoot under 14 days, we can give you a better deal. But if the shoot's going to take longer than 14 days, we're going to have to make enough money so we can make at least as much as we would make in 14 days, plus the amount of tax on the amount you're paying us. So anyhow, so that's how that works. So rental use of a home, vacation home, you pay. You have to divide your taxes up based on the total rental days, but divided by the total days used. And you can see that in Exhibit 14-4. In determining how much is personal use for mortgage interest and property taxes and all other expenses, and then how much is rental use. And the rental use goes on Schedule E, And the personal use for your taxes and interest, that's going to go on your itemized deduction schedule, which is Schedule A. So you have to split those up. And so the personal use might get so low that the standard deduction is a better deal for you, but then you can take the rest of the expense on Schedule E. And there's an example of that on page 14-23. There's actually a completed example of a full Schedule E. Now, I can tell you, I am not going to ask you about Schedule E on your final exam, although you may see a quiz question about it sometime very soon. I'm not going to make you prepare Schedule E as part of any tax form. That's not part of your project for this week. But in any event, just be aware that in addition to Schedules A, B, C, and D, which we've already looked at in detail, right? Itemized deductions and income and dividends and interest income and business and capital gains and losses. There's also a Schedule E, which is rental income and royalty income, and the rental income goes on Schedule E. Now, guess what? There's actually a Schedule F too. Guess what Schedule F is for? It starts with the letter F. Farming. There are special rules for farmers in the tax code. It's that's really more business tax than personal tax, but Schedule F is for farming, for individuals who have farms, report their income and expenses on Schedule F. So in addition to your real estate business, if you take some of that extra land, instead of developing it and have a pasture and, let some cows graze or, grow some corn or something, you can use Schedule F. Okay. Business use of your home. This is Learning Objective 14-6. And this is all about the home office deductions. I've had a lot of experience with this. When my old law firm was getting started, this is now the Culp, Elliott and Carpenter firm in Charlotte, which is probably the largest tax-oriented law firm in the state of North Carolina, just as far as a specialty practice. Our largest client was Dexter Yeager, who was the largest Amway quadruple diamond or quintuple diamond Amway distributor in the United States, and he lived right there in Charlotte. And you could always tell when you were driving past Dexter Yeager's house because he had 3 Rolls Royces parked out in the front driveway to have this ostentatious display of wealth as far as how well he was doing selling soap in the Amway business. And what I learned in representing a lot of his down-leg distributors, a lot of the ones who were just, regular diamonds or emeralds or some of the other classifications in that business, is that they all had very substantial business use of their home, because that was a business where you were distributing product for a corporation up in Michigan, and you'd receive it at some drop site in the middle of the night and bring it home and split it up in packages and send it to your customers or your other distributors for further distribution. It's just kind of a network. It was a very, very, very slow version of the internet. Okay, it was an internet with trucks and cars and trunks of cars full of products that were being distributed, but it was a business model that cut out all the marketing expenses and all the warehousing and wholesaling profits that you had in regular businesses, and allowed the company up in Michigan to charge a higher price than they otherwise could sell to wholesalers and still allow somebody in the middle to make some money pushing the products down the line. So what are the home office deductions for? Well, they're for taxpayers who use their home or a defined portion of their home exclusively and regularly, either as the principal place of business for any of the taxpayers' trade or business, or a place to meet with patients, clients, or customers in the normal course of business. And so if if your home is either the principal place of business for a trade or business, or a place to meet with patients, clients, or customers in the normal course of business, then that portion of the home that's used, or the home itself, if it's all used regularly and exclusively for that, can qualify for its expenses, the expenses of running the home, to be deductible. Now, what expenses would be deductible? Well, it can be your utilities, it can be the taxes, or at least the portion of the taxes on the home, so you wouldn't be subject to the $10,000 limit. It can be interest, it can be insurance, it can be repairs and maintenance, it can be expenses that are allowed to be, improvement expenses that are allowed to be expensed under Section 197 instead of capitalized, and it can be depreciation on the home itself and the improvements that are used in the trade or business, that have been placed into service in the trade or business. So it can be a very large percentage of your overall living expenses if you operate your business out of a very large percentage of your house. Now, they've changed the rules so that if you have less than 50% of your home that's used for business, then you can't deduct a net loss from all those deductions. But you can deduct enough of your expenses to zero out your income. And so that's also discussed in these tiers and the limits on the deductibility of expenses. And they're actually a little more complicated than what I'm discussing. I don't know why I'm getting that kind of spam on my computer. So anyhow, the expenses for the business use of your home are reported on a special form called Form 8829, and you can see that. And then you can also see various flow charts at the end of the chapter on the tax rules related to homes used for rental property, and there's 2 pages of that. And then a sample settlement statement for the Jeffersons, where you can find some of those expenses to pick up on the closing statement to use for some of the calculations that we've talked about in the chapter. Okay, it's 12:46. We're at